Welcome back, traders! Today, we're going to dive into a fundamental concept of technical analysis that plays a crucial role in trading strategies. It is called the moving averages. Whether you're new to trading or an experienced investor, understanding moving averages can give you valuable insights into market trends. So, let's get started. First off, what exactly is a moving average? Well, it's a calculation that helps smooth out price data over a specific period of time. It enables traders to identify trends and potential entry or exit points in the market. There are three main types of moving averages we'll cover today. 1. Simple moving averages, or SMA. 2. Exponential moving averages, also called EMA, and weighted moving averages, or WMA. Let's begin with the simplest one. The simple moving average. The SMA is calculated by adding up the closing prices of a specific number of periods and then dividing it by that number. It's called simple because each period carries equal weight. That is why when you click on the settings icon of the indicator, you have periods. Since it is a daily chart, the period here represents days. Look, when we make the period 2, for example, the chart is not so smooth now. But as the number of periods increases, so does its smoothness. Now let's change it back to 30. This is a simple moving average. The formula for calculating the SMA is as follows: add up the closing prices of the desired periods, and then divide it by the number of periods. This will give you the SMA value. Very simple and easy, right? Now, let's see how a simple moving average can be used in a trading situation. Imagine you're analyzing a stock chart, and the price is consistently trading above the 50-day SMA, like here. This indicates an uptrend, suggesting that the stock may be a good candidate for a long position. Conversely, if the price falls below the 50-day SMA, it could signal a potential downtrend and be a signal to exit or consider a short position. Moving on to the exponential moving average, or EMA. Unlike the SMA, the EMA gives more weight to recent prices, making it more responsive to price changes. This responsiveness is what makes the EMA a popular choice among traders. The EMA is calculated using a formula that incorporates a smoothing factor or multiplier. The formula for calculating the multiplier or smoothing factor is derived from the number of periods you want to consider. Let's break it down. To calculate the smoothing factor, you can use the following formula. Smoothing factor equals 2 divided by n plus 1. The value of 2 as a smoothing choice in EMA calculations does not have a specific interpretation or represent a particular concept. It is a convention that has been widely adopted and found to produce satisfactory results in many practical applications. Here, n represents the number of periods you want to consider. The smoothing factor determines how much weight is given to the most recent period. To calculate the first EMA value, you can use the simple moving average, SMA, for the initial period. Then, you can use the EMA formula to calculate subsequent EMA values, giving more weight to recent prices. So, calculating EMA for today equals closing price times multiplier plus EMA of previous day times 1 minus multiplier. Multiplier is of course 2 divided by n plus 1. It's important to note that as you calculate more EMA values, the previous EMA values become less significant as they are diluted by the new data. By incorporating the smoothing factor into the EMA calculation, the indicator becomes more responsive to recent price changes compared to the simple moving average, SMA, which gives equal weight to each period. Now that you know what EMA is and how it is calculated, let's see how traders use it in trading. Using the EMA in your trading analysis allows you to capture trends more quickly and identify potential entry or exit points based on recent price movements. Now, let's imagine we're looking at a stock chart, and the price is crossing above the 10-day EMA from below. This crossover could be seen as a bullish signal, indicating a potential buying opportunity. On the other hand, if the price crosses below the EMA, it may suggest a bearish signal and prompt you to consider selling or going short. It is just a signal for entry and exit, just like all other technical indicators. You should use it only if you have established bullish or bearish views on a specific asset or security. It can only help you highlight entry or exit points based on your views. To make matters clearer, let me ask a simple question. If the price is above 50-day EMA and you have a bearish view based on your analysis, should you enter a long position? Of course not, because it is a temporary hype that will go back down. Finally, let's explore the weighted moving average, WMA. This type of moving average assigns different weights to different periods. The most recent periods carry the highest weight, while older periods carry lower weight. The formula for calculating the WMA involves multiplying each period's price by a predetermined weight and then summing up these weighted prices. The formula is broken down into 4 steps. Step 1, we identify the period. In this case, it is from the 2nd of June to the 15th of June, which is 10 days. This bit here, along with the closing price. Step 2, we give weight to the closing price for each day, with the highest weight to the most recent price. In order to do that, we add from 1 to 10, which is 55. Then we calculate the weight for each period. As you can see, the recent date has the highest weight, which is 10 divided by 55. Step 3 would be to find the price for each weight, which is simply multiplying the price by weight. Step 4 is adding up the entire column, which is 4,344.558. And this is the 10-day WMA for S&P 500 for the mentioned period. You don't have to worry about these calculations because they are done automatically as you select an indicator. You just have to adjust the parameters based on your trading strategy and understand exactly what the indicator means. Now, let's apply the weighted moving average in a trading scenario. Imagine you're analyzing a stock chart and the price is consistently trading above the 20-day WMA. This suggests that the stock has been performing well recently and could indicate a potential uptrend. It may be a signal to consider entering a long position. Conversely, if the price falls below the 20-day WMA, it could suggest a potential reversal or downtrend, indicating a possible exit or consideration of a short position. To summarize, moving averages are valuable tools in technical analysis that help smooth out price data and identify trends. We covered 3 main types: simple moving averages or SMA, exponential moving averages EMA, and weighted moving averages or WMA. The SMA is calculated by summing up closing prices over a specific period and dividing by the number of periods. The EMA gives more weight to recent prices, making it more responsive to changes. And the WMA assigns different weights to different periods. Remember, moving averages are just one tool among many in a trader's arsenal. They can provide insights into potential trends and entry or exit points, but it's important to use them in conjunction with other indicators and analysis techniques. So, as you continue to explore the world of trading, make sure to experiment with different moving averages and see how they can enhance your decision-making process. That's it for today's episode. We hope you found this exploration of moving averages helpful and informative. Stay tuned for more trading tips and strategies in our future episodes. Until then, happy trading and see you next time.